Good Friday morning, Market Chameleons and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. This man, Dimitri Pargamanik. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for. So with that, I will share my screen.
Excellent.
And as I'm doing it, if you're joining us for the first time, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, you could type it into the live chat on YouTube. Will's watching it. He'll read it back to me. If you want to come on a show and ask your question live, you could also, we provide a link to Zoom. Click on that link. When you get to Zoom, click on raise your hand. That lets us know you have a question. Once we let you in, you could ask your question live and direct. So while we're waiting for more people to join us and to give you guys a couple minutes to put in those questions, we'll start out looking at the pre-market report to see if we could get insights on what's trading in the pre-market hours, and then we'll move on to the questions. All right. So pre-market report. These are stocks trading in pre-market hours. I'm going to come down here and we see we have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. Here I see 166 stocks made our percentage gainers list, 34 in the decliners. So far today looks like this trading in a pre-market hours has bullish bias, okay, or bullish sentiment. Let's look at it from another perspective. I'm going to climb up here. We have this calendar view by date. If you click on it, you get a summary of the pre-market trading on that date. Currently, we're September 29th. And so far today, we got 520 stocks trading higher in the pre-market hours, 165 stocks trading lower. As far as volume of shares, we got 279 million shares on up volume versus 39 million on down volume. And if we convert that volume to dollar value, we have $3.3 billion worth of stock trading higher versus 317 million shares trading lower. And this, from the high level, also indicates that there is a lot of bullish enthusiasm, bullish sentiment in the pre-market trading. Let's do one more check, and then we'll move on to the questions. We're going to look at it from a different perspective, and we're going to filter it down this list, because if you see this list of pre-market trading has small cap stocks in their ETFs, closed-end funds. So any security listed on a major U.S. exchange, if it's trading in pre-market hours and it meets our thresholds for liquidity, volume, price, it can make this list. And to narrow it down to a small group of stocks, you can use the filters here above. If you have a watch list, you could filter by your watch list. We're going to use this one, an ETF filter, as an example. I'm going to click on it, get a drop down, and we see different ETFs to select from. SPY, that's the S&P 500 ETF. I'm going to click on that. And when we do that, the list below gets filtered by stocks that are holdings in the SPY, which are the S&P 500 constituents. And we see here 26 made our percentage gainers list, none so far in our decliners list. So all three of those insights show that so far trading in a pre-market hours is lined up, with a bullish bias, bullish sentiment. I guess we gave it a couple minutes. It was kind of quick, Will, but if we do have questions, I'll take them. I think there are some over the email. We could start with those.
Yeah, let's start with those. Nothing's popped in yet.
Okay. So let's do a couple of things here. There was a question about the trade idea cards.
I think the question was at the end of the day, and I'm not sure if it was Rob, but they asked if there was a record of the card to the end of the trade, was I think the question anywhere on the site.
Right. So first of all, it's important to understand what's going on here, all right? Because that question itself, it's implying and assuming something within that question, right? What is it assuming? That this trade card has some kind of a target price at the end, right? Like there's that it's trying to predict or forecast something into the future. That's not what's going on here. That's an important, because the underlying assumption is that, right? Because you could see here, there are 3 different trade cards, and those trade cards, right? Look, I'm looking at it right now, right? All of these are different strategies, and some of them are on opposite sides. Here's a long put, that's a bearish strategy. Here's a bull put spread, that's a bullish strategy, right? So the outcome, so the payoff itself is dependent on the outcome of something happening in the future that we don't know, right? We don't know where SPY will be in the future, right? We don't know if it's going to be up. We don't know if it's going to be down. We don't know if it's going to be unchanged. Like this debit iron condor, this is not even a directional, right? Debit iron condor, it's a volatility, right? But they all have, so why are we filtering them out? Why are we showing this? And it's important to understand, what's going on here, right? Because one, even though they all have edge, there's some of them are going to pay off, some of them are not, right? Because they're going to still be dependent on a future outcome that we don't know. So if you want to, you could track it, you could, if you're just interested in it, just to see how it plays out, you can, if you click on this here, like see this options chain, this will set up the strategy for you in the options chain over here. So here's the strategy. We can calculate it. This is the strategy: buying the 418 put, selling the 421 put. For the credit, you can do further research and say, you know what, I just want to track it and see how it comes out. So you could just add this to your watch list, right? Like this. It added it to my watch list. I'll just show you this so you know if you actually want to do it. Once you go to your watch list, just click on down here, strategy, and it appears here. Here, SPY. This is a strategy. You could track it. You could change the prices if you want. You could edit it from here, and just track it. And if you wanted to go back, this will keep track of if it's going up or down. If you want to go back, you could press on this. It'll take you back to the options chain. But here's why you need to understand what's going on with this, because that's not the point of this is not to try to see or predict what the outcome is, because that outcome is random. You have to understand that because you will not understand the statistics behind it or how to effectively use it, right? So look, what do we mean by that, right? What does this mean? Because this here, these market prices, theoretical values, are dynamic and they're changing over, this could flip, right? This is at one moment in time what we're calculating. So think of it as, if you're playing poker and every time there's a new card that's drawn, then all of a sudden everything gets recalculated, right? If you're playing a football game and you're trying to, try to figure out what the score is at the end. You could make a prediction, but as it's going, things are changing, right? Because everything's dynamics. The market doesn't like stop here and then reopen, when is this? October 20th, right? So from now to October 20th, it's continuously changing. So as it's changing, these are also changing. So this is one point in time. But how do we evaluate it, right? How do we evaluate the trade? And here's we started talking about this yesterday, that when people think of events as random, they think, well, if something is random, well, then you can't predict it. Obviously, there's no way to predict it. But that doesn't mean that randomness cannot be modeled and applied mathematically to find probabilities, and those are tradable. Like when you think about a casino roulette table, it's all random. You don't know if the next, outcome is going to be green or red. We don't know that. We don't know which number is going to come out, or if it's going to be even or odds. It's random. They spin it, and there's no way to predict it. But what we can calculate is the probabilities of any one of those spots, right? And the payoffs. And based on that, can you create a practical model to trade around, right? To make bets around, right? So when we have a random event, we're not trying to see if we got the outcome correct, right? Did we get the odds, right? Do we get the odds and payoff correct? That's what we're trying to figure out. So when we look at this card, what does this mean? Theoretical edge, right? Theoretical edge doesn't mean that in theory the price of, in a long put, that the price of the stock is going to go down, and the put is going to go to 533. That's not what it means. What it's saying is that we don't know if the stock's going to go up or down. We don't know that. However, in theory, right? In theory, if it does go down, if it does go that way, then we stand to make a little bit extra on our put because we're buying it a little bit cheaper. And if it goes up, and we don't know if it will, but if it does go up, then we didn't lose as much in theory as we would have if we paid the average value or fair market value. Okay, that's what the theoretical value is. So we don't know if the outcome will be a hit or not. What we're saying is that there's a little bit of extra edge, right, in there, that if it does pay off, well, we're getting more than really we should have. And if we lose, well, we didn't lose as much as we should have. So let's look at that example. Right. And I'm going to make a simple one, right? Heads or tails. And do this one. One's heads, one's tails. And it's important to start changing your mentality this way, because otherwise, you're thinking of evaluation like you would a mutual fund, right? But it's not. Trading isn't a mutual fund, right? You're not looking at the performance of some, manager sticking to some benchmark. This is trading, right? So trading is many trades, and each trade in itself you have to value. But let's look at this heads and tails, right? Well, we could make this evaluation, and we talked about this before. And if I take the data and I say, well, the heads has an edge, right? Heads has an edge. And then you say, okay, That's great, Dimitri. Heads has an edge. And then you say, let me see the outcome of the trade. And let's say tails lands. Tails lands. And you're like, oh my God, this is not working, right? It didn't work because heads had an edge, but the outcome was tails. So was that then the wrong bet? Was that a bad bet, right? Do we miss something, or was it a good bet? It's just that the outcome was random. It didn't hit heads. So that's how we have to evaluate, right? Was it still a good bet at the time because we didn't know what the outcome is? So I'll give you an example, right? I'm going to make it really skewed that it will be obvious to everybody, right? Let's say that we knew 50-50 that, a chance that it could land in tails, it could land in heads, right? If it's 50-50, well, there's no edge until somebody tells us the payoff. And let's say that somebody came up to you and said, look, I'll give you $1 million if it lands on heads. And if it lands on tails, you give me $1. Well, it should be obvious to everybody, like that, even though it landed on tails and you lost $1, it was a good bet, right? You stood to make $1 million and you had a 50-50 shot to lose $1. So evaluating just the outcome alone, but if we just looked at this alone, it would have seemed like, well, that was a dumb bet because now the outcome, we didn't know this ahead of time, what the outcome will be. We just wanted to know at the moment in time, well, why was it a good bet? Well, because in theory, if we won, we would have won way more than we should have given the risk, right? We won way more. We won $1 million, but we only risked $1. So it was a good bet because the payoff was way greater than we should than in theory and in statistics it says, right? And if we lost, well, yeah, great. Okay, we lost $1, but really, in proportion to what we could have made, we lost very little, right? Because the expected return, the expected value was much greater, right? Like $500,000, right? That we paid $1 for. So to make that evaluation, that's where you have to start off. Are the odds and payoffs correct at the time of the trade, right? Did we miss something, right? Because this, the casino, even though people, sometimes somebody could come in the casino and win 10 rolls in 10 times in a row. But the casino doesn't say, oh my God, then this is wrong. They know that could happen. It's random, right? They don't like, shut down their business and operations and say that's it. Because they know the odds, they know the long-term odds, they know the edge and so forth. So that's what's important to understand that. But how do we know these odds, right? How do we know these odds in the stock? That's the question, because in the heads or tails, it's pretty simple. There's only two outcomes, right? And if somebody tells us there's $1 million to bet on heads and $1 on tails, that's pretty simple too. I mean, probably somebody in grade school will understand that, right? But when we talk about options and stocks, it's not that easy, right? Because the odds are not there that are stationary and fixed, right? They're not, it's not like this stationary odds that we could depend on to calculate every time. We're estimating these odds. We're estimating them from the data. What do we think the odds are of this or that in the payoffs, right? And that's where it gets tricky. That's where we have to rely on data to start creating a base model of what we think the odds are in theory, so we could start pricing out these strategies and to see how far away are the markets from our theoretical value, right? So it's not the outcome is random. So you could see here, yeah, this, right, for this to pay off, the stock has to go down. It has to go down for the put to pay off, just like, just like for this heads to pay off, the outcome has to be heads, right? But, and we don't know that. So this could be a loser, or this one could be a loser. Was there extra? In theory, was there an extra edge when we took on this bet that if we did lose, well, we didn't lose as much as we, in theory should have. And if we did make, right, we did make, like maybe it goes to $6, right? Then we made more, right? Because the difference between this and this, we made more than we really deserve statistically to make. So that's the statistical edge, the theoretical edge. Okay. So you could follow the trade, but it's not, if you're just looking at the outcome alone, did the stock go down, or did the stock go up? Because each of these has a different outlook. There are 3 different trades here. Each of these has a different outlook, right? These are different options, but they all have a different outlook in the stock. The idea is, is there, in theory, some edge, something extra you're getting in the risk that you're taking? Okay. Hopefully that makes sense. Let me know if there's a follow-up question to that.
All right. Well, everyone, I think that came from Rob, but let us know if that answers the question. I know Rob had no idea you could drop the trade into his watch list, so we found that very interesting. So thanks for showing that, Dima.
Yep.
We got about 8 minutes left. What was the other question that came in?
I think there was a leftover one. Let me go to the options trade screen. Options block trade screen. And when we have a theory, right? When we have a thesis or a theory, we usually want to test it. And to test it, we need some data, some historical data. It could be going back far, or it could be just more recent data. But it's important to test your theories first, because you're going to learn kind of from 3 different ways. You're going to learn first, you're going to test your theories on historical data to see, how things pan out. Then you're going to do, if you do an analysis on historical data, then you're going to test that theory, what we call out of sample. Then you're going to test it on unseen data, right? You're going to say like, okay, well, in theory, and it'll still be on historical data, but it'll be on historical data your model didn't see yet, right? And then you're going to learn from that, because you're like, well, how much was I on spot? How much did I error? And then probably, the biggest test of all is when you go live. And live, it's rarely anything like you did in theory, because then you really then start seeing how things actually work, live execution and managing the risk and all this. So it goes through 3 phases, right? You go through those 3 phases to start creating your model, your trading, and you're going to be tweaking all along the way, right? All along the way, you're evaluating stuff. So I came to the option block trade screener because this is a common theory that I hear, right? Thesis. And I'll set it up, but it's looking for a large trade. All right. So I'm going to just look for a single leg trade. I'm going to filter out any multi-leg for now. So I'm going to filter out a condition where the trade has to be an auto execution, a regular trade. It could even be an intermarket sweep, but there's no other trade tied to this. It's not part of another leg, which would be a multi-leg, like a spread, a call spread, or strap. So then the thesis goes like this. Show me a very large trade. So let's make it over 1 million in notional, right? So here's 1 million. This is 2.3 million, right? So SPY 500, puts traded for this much. That's 2.3 million in notional. And then they'll say, well, show me one that looks like it was a trade that happened on the offer. Somebody was buying the option. So asking about, right? And I think somebody brought this somebody brought this up, a similar trade where, following, what do they call it? Big money or smart money, right?
Smart money or big money.
Right. All right. So let's say you have this thesis, right? And usually the people who have this thesis say, I need, without ever testing it, even without ever actually evaluating it, or no kind of proof, they want to do this in real time, forward tested. I need real-time quotes. I'm just going to go jump on this, right? So they'll sit there and right away, and you could do this, lots of times throughout the day, but they'll go and just forward test it. And usually, they're going to be done pretty quickly, right? Because they really don't know what they're doing. But what would we do though if we had this thesis, right? Well, first we'd want to go and test it out, right? And say like, well, how often does this happen? And if I did this trade, right, what would be the outcome? Like what's happening around here? And you could go look at today's data, right? You could even look at today's data and say, well, what would happen if I jumped on this? Like before I even go and do this live, does it even make sense? Or something else going on that I need to build up into my model. And that's how you start developing your thesis. You want to go and get some proof, right? You want to go and say, does this make sense? Does this behave like the way I expected? Right. And we could go back even a couple of days if we want to. Let's go back and we could, look if we wanted to see from the 25th, how did this trade perform? Right. So here's one in Tesla, somebody bought it 610. Probably this one did well, we'll take a look at it, but here's a big one for 1 million. There are puts here in IWM, Amazon. So you'd have to start going in there and saying, well, how did these perform? Right. So let's just take a look at it. So here's one in Tesla, right? This is the original price. Somebody paid $6.10. Let's say you just believed in and you jumped on that, right? You jumped on it and you're like, that's great. This is smart money or big money, whatever you call it. And you jumped on it. Now, Tesla, where's Tesla right now? Well, this is where Tesla was at $242. So Tesla right now, yesterday was 246. Okay, wait, it's right here. 246. All right. And you could see it's up 1.5%. So it's up 1.5% from the time of this trade. But look where the option is yesterday. It's down, right? You could see that it from 610 right now, it's 575, 585. We don't know where today it's going to be, but you could see that these are no like layups here, right? But does that make sense? Why would these be layups, right? Like intuitively, we have to rationalize it. Would that even make sense to jump on this? Because if it did, if that worked every time, right? If it was that easy and it worked every time, don't you think that there would be big banks and huge institutions and algorithmic trading and everybody in the world automatically just jumping on these trades? Like we would be able to see as soon as this trade 610, if that was an easy layup like that, we would see that millions of people starting to jump in there, but that doesn't happen, right? So logically, it wouldn't work that way, right? And you could test that thesis, right? The important part is like your beginning part is you have the data here, test it, prove it. You know, the most expensive thing you could do is try to forward test it. You know, especially if you don't know what you're doing, because if you're forward testing, don't know what you're doing, you're probably even leaking more things for things you don't even know about, you know, with as far as execution and risk management goes. So it's a really bad idea to try to go in there and jump on things and forward test. Now, I'm not saying you can't get lucky. Of course, you know, this is risk. It's a game of luck. The outcomes are unknown, but in practice, it's bad to just go and forward test things like that without at least first going back. I mean, this is a few days, right? This isn't that long ago. You could go look at all these, and this one came up, right? This one came up. Follow. These are $1 million trades here, and you could see how, you know, what the outcomes were. Look, you know, here you go. These are the outcomes. You can see the implied volatility, what the stock did, and so forth. And this is where you start gathering your data, your evidence, and formulating a real plan. All right, so hopefully we're up at 9.
Yeah, that was great. I know we're a minute into the opening. Rob, just can you really quickly show how you got to this screen?
The option block trade screen?
Yeah.
So under screeners, option blocks trades right here.
Yep, and then you clicked on that, and then I think there were tabs at the top, that's the
yeah. Well, I've set these filters here, and
Yeah.
then I went to the performance tracking. So I went from the main to the performance tracking.
Perfect. All right. Hopefully that helps, Rob. Again, thanks everyone for the questions. Keep them coming. Suggestions also. I sent one to you. Mike McCray asked for something, D in the 52-week high low. Maybe you can take a look at it, see if it's something we can do. Awesome job, buddy. You have a great weekend.
Yep.
See you Monday.
Yep. Thanks everyone for joining. Stay safe out there. Have a great weekend and hope to see you guys on